welcome to our next episode. In this one, we're going to talk about a bit of a technical type of issue. This has got to do with a recent case, 2026 High Court of Australia case called Commissioner of Taxation versus Bendel. I've got Alex with me again. Welcome, Alex.
Thanks, Venkat.
This is one that's been brewing, hasn't it? This is about unpaid present entitlements and trusts and companies and all that sort of stuff. And it's been a long time in the making. Not the case itself, but the idea of what's happened as a backstory.
Yes.
Let's just talk about the backstory and where it all starts from. So the tax office says, almost 15, 16 years ago, that if a trust makes a distribution to a company but never actually pays the amount, that constitutes a loan by the company to the trust, and that becomes a deemed dividend, which is then taxed in the hands of both taxpayers.
Correct. Yeah.
So that's been their policy for quite some time.
Yeah, correct. And I think why this case is important is because trusts have always been an important tax planning vehicle in Australia. You know, we always consider trusts to be an asset protection vehicle primarily, but also with the current tax rules, it allowed us to spread or distribute income in the most tax efficient manner. Right? And when you look at tax rates for individuals to companies, it was always beneficial if you didn't have individuals on a lower tax rate to distribute to a company. So that's why it's an issue that's current. And we also have to look at it in the light of the recent announcements in the May budget as well. But when you look at what happened with the case of Bendel, now, he was a good person. He was an accountant. All right. And
let's not jump to conclusions, Alex.
He's right, he's an accountant. And he invested funds in advisors trust, made a lot of money, and he wanted obviously to distribute in the most tax efficient manner. So obviously he didn't have individuals that would be on a lower tax rate. So he used a corporate or a company as the beneficiary. Now, when you make the decision to allocate or give somebody rights to that income, then they have an unpaid present entitlement. And that would always be income to them. So that was the one taxing point. Now, if you don't pay out that money, then the trustee has to recognise a liability, which we call the unpaid present entitlement.
Yep.
And this issue that the tax law says, hang on, that's a loan. And there are separate provisions that say when loans are made to certain parties, if they're not repaid based on a fixed schedule, we'll also tax it again. And that's this concept of double taxing that Venkat mentioned. And that's the issue that people obviously were concerned about. And that's why it went all the way to the High Court to get a final determination. Whether the fact it hasn't been paid, but it's recognised as a liability, is a loan. And that's really the fundamental issue in Bendel's case.
That's right. So, in fact, you've just summarised it very well for us there, Alex, and I had the slides up as you were speaking as well. In short, that's exactly what happened in the Bendel case. And so then the Commissioner, of course, took this to the High Court, and the High Court had to then come up with a decision. So what did the High Court have to decide? They had to decide, does this unpaid present entitlement constitute a loan under Section 109D of the Income Tax Assessment Act 1936? So that was the first question. And of course, if they found that in the affirmative, then they would say that the resulting unpaid present entitlements become deemed dividends and get taxed, as we said before, in the hands of both the taxpayers. So, Alex, let's talk about who won that case.
Yes. So as a result of going all the way to the High Court came down in favour of the taxpayer and said the unpaid present entitlement, so the liability that sits in the trustee accounts, is not a loan.
It's not a loan, that's right.
It's a loan under Division 7A. So it was a win for the taxpayer. Now, unfortunately, you'll find, if you look back to history with the ATO, whenever they lose a case, they lobby the government to change the law or the legislation. So
that's right.
You might win in the High Court, but remember, legislation will override court cases sometimes.
Yes,
so we just
because
that, yeah.
That's right. And I guess that's the point of having a Westminster parliamentary system, that the Parliament can actually overrule, not overrule, but it can make laws that that effectively defeat a High Court decision. And just to finish off the discussion about that court case itself, the court did also say that Section 109XA or 109XB would be much more suited to this sort of scenario in Bendel than 109D. And really, those are things that I guess they're more sophisticated issues for us to think about for later on and down the track. But it certainly is important to note that as well, just in the context of this case. So the long and the short is, for a long time, the tax office had put out a ruling saying, if you do this, basically it constitutes a Division 7A loan, and you need to have a sub-trust and then have a complying loan agreement between the company and the trust. And that means that we won't treat it as a deemed dividend. We won't treat it as basically a penalty tax. So we haven't seen a tax ruling since this decision, have we, Alex? I don't.
No. And I think the issue is that, a lot of taxpayers in the past would have complied with the ATO ruling based on the advice of their accountants, because
Correct.
the ATO's put out a view, and you generally say, if I don't agree with the view, we're going to have a fight, so let's agree with it, which means you would have paid excess tax.
Well, exactly.
Now he's saying, well, hang on, based on Bendel's case, can I go and claw it back? But remember, there are time frames in which you can claw back or ask for an amendment. And some of them may be out of time as well. So you're sort of lost, even though Bendel won. But the past, how can you unwind things beyond certain statutory time frames as an issue?
That's practice. That's right. So for most people, your amendment period is either 2 years or 4 years. For most individuals, it's 2 years. For businesses, it can be up to 4 years. And certainly you can't go past that. The ATO, of course, can go beyond that if they need to, if they suspect fraud or evasion, but it doesn't go necessarily the other way.
So you might argue, Venkat, hey, there was fraud or evasion. Let's go back as far as we want.
Well,
so sometimes you've got to play the game.
I'm not sure that's going to work, Alex. And look, I think in a way, I guess, like I said, there's a couple of issues here. One is, they do have to come up with a response. They need to make a decision impact statement sooner or later and let people know what this means going forward. I don't think they'll bother. Well, they certainly can't appeal this any further. They may, as you suggested, have government enact laws. But I guess just from a process point of view too, the Treasury actually recommends government change laws. The ATO can feed into the Treasury. But the ATO is actually very careful not to play into the policy angle, because they tend to say, where the administrator will sit back, will give you the advice, you decide what to do. Not defending them here, but just in terms of the process as it works, right? And I
think that's this other point too, is you mentioned before, Venkat, that the High Court said they should have considered 2 other provisions. And that gives a leg up, unfortunately, to the ATO. So, okay, we lost on 109D, but these other 2 provisions you mentioned we should have used, well, let's use those. So you need to be careful when you read the judgments that just because on the face of it, he won, there's this part that says, if he did this, he may not have won. And that's what they try going forward. So just be careful when you read judgments that, majority rule doesn't always mean it's correct.
Yes, and it doesn't necessarily mean it's a win in the sense of the taxpayers' circumstances, Having said that, though, Alex, in the broader context here is that trusts, yes, we can say they're used for asset protection or whatever else, but they have obviously been a very effective tax vehicle for people. And certainly salaried employees have had no such options. So to balance things out, at least in my view anyway, to balance things out, the government has proposed a bunch of changes. You probably won't agree with them, but with the new changes that are coming in, and if we now talk about the Bendel case in the context of the 30% minimum tax that's going to be applied onto trusts, discretionary trusts in particular, let's talk about that for a couple of minutes.
Okay, so in the May budget on the 12th of May, the government said besides changes to capital gains and gearing, they also looked at trusts and said we don't really like trusts. And what we want to do is effectively tax them as if they were companies. So when we do a distribution to you, Venkat, or to me, or to a company, there's got to be a 30% minimum tax taken out.
Correct.
So sort of like a company taxing its profits, and then the balance is then paid out to the respective beneficiaries. Okay?
That's right.
Remember, minimum. So that means if the rate of the beneficiaries is higher, they still have to pay the top-up tax to the marginal tax rate. All right.
Yes.
So the tax office or the government access to tax earlier than waiting for the beneficiaries to do the returns, pay the tax, etc. All right.
That's right. That's true.
Yeah.
by the same token, though, it does mean that there's now sort of neutrality between companies and trusts, because there's no real advantage of having a company or a trust. And actually, really what they want is they want people to use companies for trading rather than trusts.
Correct.
And so that
is that in the budget they talk about this concept of bucket companies, which is really just putting as much money as you can into the company, because that was the lower tax rate. And with these changes, it sort of takes away the use of these sort of structures to be beneficiaries of trusts. Right?
That's right. That's right.
In practice, most people, most accountants, us good guys, would tend to take the view, if you're going to operate a business, you tend to use a corporate structure more so than a trust structure. Right?
Which gives you all sorts of protections anyway.
Yeah, because the difficulty has always been, if it's profitable in your trust, who do I give it to? And you look at your own family circumstances, and the majority of trusts like to give it to family. But you've got to have a lot of family members that you can utilise tax efficiently, and sometimes you can't.
Sometimes can't, yeah. So, and with the changes that have been suggested, which we've spoken about in previous videos as well, is that, you know, the 30% minimum tax, you can get it back if you're a taxpayer, individual taxpayer, but you can't get it back as a franking credit equivalent if you're a company. So this idea of giving trust distributions to a company now is basically pointless.
Correct.
Under the new rules, unless you just prepared to pay the 30% tax anyway. So in a way, the Bendel case is really useful and important and interesting, because it shows a lot about the process. It shows a lot about what the ATO says versus what the law sometimes can actually mean. It reminds us that tax rulings are just the commissioner's view; they're not the law, and that they can certainly be wrong. But from a practicality point of view, once we go to 30% minimum tax for trusts, this whole idea of distributing to companies becomes redundant anyway.
Right. Yeah. One final point, I guess, when you look at the Bendel's case, you sort of say, well, you're an individual. How could you afford to fund a case all the way to the High Court? Because it's costly.
Yes.
If you lose, you've got to pay the costs. So you need to be aware that the tax office sometimes says, look, if this is a key issue that we want to resolve, we'll have a taxpayer-funded litigation program where they will fund the cost to go to the High Court.
Yes.
So if you are really a principled person, you want to fight to the nth degree with the ATO. If it's a key issue that they are concerned about, then you may get them to pay the costs.
Yeah, that's exactly right. I'm not sure if this one was actually funded by the tax office.
I think funded it himself, because he's an accountant and he's wealthy.
Yeah, I think I've forgotten the name of it, but you're absolutely right. There is a program where the ATO, where they want clarity themselves from a court, because at the end of the day, they know that they don't make the law, right? They just interpret it and to apply it. So, anyway, very interesting case. I think it's certainly it's going to force people to rethink a lot of things about the way things have gone, and maybe the tax office will also have to reconsider whether a certain amount of refunds are due from the past, and it would be interesting to see how all that goes.
That's right, and I think as accountants in practice or as students learning tax law at university, I think the key point is that there is a decision, but it's not the final decision, because they will need to be. How do we actually practically implement what the High Court case said? Yes. How is the government going to react? Yes. And just as Kat has said, yes, the tax office has issued rulings, but rulings are their guidelines. You don't have to follow them. But you have to have a strong argument why you should follow, why you disagree. So there's still issues to be in practice to be resolved. So just because on the face of it, the tax office lost, doesn't mean they may not win the war.
That's right. And on that note, I think we'll finish up this week, Alex, and it certainly means that we've got plenty more to talk about in future podcasts.
All right. Thanks very much, Kat.
Thanks, Alex.